A lot has been said in the recent past about domestic flows as well. We're seeing SIPs to the tune of 13,000 crore rupees in a month. You're seeing significant inflows from the EPFO as well, supporting the Indian equity markets. How do you compare this to perhaps even a decade ago? And where do we see this going right now from this point on? Which leads me to another question in terms of the offerings of the mutual fund industry. Have they essentially covered all the bases as they stand right now? Or do you think that there's more to be done in the bouquet that is being offered?
So 2013-14, before Prime Minister Modi won the first election in 2014, April, May, there was about 3% of household savings in India found their way to stock markets. That number today is probably about 7-8%. Now keep in mind that household savings in absolute terms are growing. Look at this is the percentage. So and the percentage is doubled. So there's more flows today in equity mutual funds and stock markets, either individual stocks or equity funds through SIPs, national pension system, insurance plans, etc. And that's a big win. But we're still a lot lower than the world. In the US and the developed world, keeping Germany out because Germans are a bit more risk averse and don't really buy that much stocks. You've got about 30% as a number that you want to achieve or want to get towards to kind of be comparable to what's happening in the US or the UK or Australia, New Zealand, etc. So at 7%, we still got a long way to go. So we think there'll be a lot more flows moving into India for decades into the future. The question that you asked about the mutual fund industry, or rather, what should an investor do? So you may have built the most, sexiest engine to transact and buy mutual funds or buy stocks. You may have a fund house with great branding all across the country and saying, I've got these, 200 funds to buy or 50 mutual funds to buy. How does the investor actually make money without taking on too much risk and without living with too much volatility? So I told you in a very optimistic way that Indian equity should give a 15% rate of return compounded for the next 2 decades, compared to 19% for the previous 40 years, for the previous 4 decades. That's a good number, 15% for the next 20 years. That does not mean that every investor will make that much money. They may end up buying the wrong mutual fund. And it does not mean either that they should put all their money into equity mutual funds, because they may put their money in and they may want their money out when a COVID hits and equity markets are down 30% from their peak and they'll be losing money, right? So you have to have a simple but well-diversified portfolio. Our grandparents told us, our parents told us, beta, beti, don't put all your eggs in one basket. That's basically the simple common truth, if you will. And that's why at the quantum mutual fund level specifically, we came out with what we call as 12-20-80, 12-20-80. Very simple way. And this is what I've been doing with my investments, my capital, since the 2005-6 environment, when I started having capital to start investing in mutual funds, etc.